Good evening, everyone. On behalf of the Frederick Hayek Program at the LSE, I am delighted to welcome you all to tonight's public lecture on the case for shareholder capitalism, how the pursuit of profit benefits all. And I am particularly delighted to welcome Professor McLean. Let me say just a few words about Professor McLean before I hand it over to him. What we're going to do is have about around an hour, 50 minutes of Professor McLean talking about the case for shareholder capitalism, and then we're going to open the floor for broad Q&A. So David McLean is the William G. Drom's Professor of Finance and Finance Area Chair at Georgetown University's McDowell School of Business. His research interests are in stock return predictability, behavioral finance, and the interplay between financial markets and corporate investment. David's papers have been published in leading financial journals such as the Journal of Finance, Journal of Financial Economics, and the Review of Financial Studies. His research has won several awards, including the Smith-Breeden Award for Best Paper in the Journal of Finance and the Jensen Prize for the Best Paper in Journal of Financial Economics. As you can imagine, all the best outlets of The Economist and the Financial Times have covered his work. And he is the author of the book that he's going to tell us about tonight, The Case for Shareholder Capitalism, How the Pursuit of Profit Benefits All. I'm particularly interested, I sort of introduced myself. I'm Nava Ashraf. I'm a professor of economics in the economics department. But I particularly think about social impact and psychology and economics. So bringing those together and thinking about the case for shareholder capitalism would be fascinating. I'll turn it over to you, David. Thank you so much for joining us.
Okay, yeah, thank you for having me here. Big honor to be here. Thanks everyone for coming. And I understand too, there's some high school students in the crowd. Who's in high school? I'm just wondering how many. Okay, good. Okay, good. I'm glad to hear that. So everything I talk about, hopefully I explain it well enough. Even if you have no finance business background, never took a college course, I should be able to explain it in a way that you understand it. If we don't, I didn't explain it well. That was one of my goals in kind of writing the book here. So I'm glad there's good turnout. So let me start just by defining it. So first of all, what is shareholder capitalism? So the basic idea is just that the goal of a business is to maximize the wealth of the owners. And sometimes people get a little bit caught up in the idea of if it's a corporation or not. So a corporation is a particular legal structure you can put on a business. When a business becomes a corporation, the owners are issued shares, and then they're then called shareholders. Most of what I'll say, though, really would apply to almost any business. For example, law firms are often organized as partnerships, and most of what I say would apply to them, too. Small businesses are usually sole proprietorships, at least in the States where I'm from, and most of what I say will apply to them. So like some lawyers that specialize in corporate law have some other things to say about this. I'll have a little bit to say about that in the end. But most of what I'm just saying is that if just someone with shareholder capitalism just is the goal of a business to maximize the wealth of its owners. And of course, it's important to keep in mind when we say that's the goal, that means with no fraud, no deception, no illegal activity. So you're not misleading people about your products and services and things like that. You're just trying to run an honest business. And you follow all rules and regulations. So if you go to university and you take a finance course, usually we'll start the course off by saying like a corporate finance course. Okay, the goal of the firm is to maximize shareholder value. The goal of the firm is to create as much wealth as it can for its owners. And then we develop various kind of analytical tools to see how well the firm is doing that. So this is where it comes from. It comes from at least what got me interested in it is that's the first thing. Even if you take Finance 101, they'll probably start Finance 101 that way when they start talking about firms. So we're just going to assume the goal of the firm is to create wealth for its owners, and then it goes and does these things, and we're going to try to measure how well it does that or doesn't do that. So why write a book on shareholder capitalism? Okay, if the goal is to maximize shareholder wealth, well, what does that mean for everyone else? Like, what does that mean for stakeholders like employees, customers, and suppliers? Many people aren't shareholders of any corporation or maybe don't even deal with a corporation. How does shareholder capitalism impact them? What role does shareholder capitalism play in economic growth and creating living standards and things like that? Those are some important questions. And unfortunately, in typical finance courses, they have little to say about that. We actually have nothing to say about it. So what we'll do, and I think finance professors, like in the back of our heads, maybe we know it and we think about it, but we'll just say, okay, that's the assumption. You got to maximize shareholder value. And then we go right into the formulas and the things like, and how do we measure this and different theorems and stuff like that. And so we never, but a reasonable student would probably ask those questions. And because we didn't answer them, and I think most of us know the answer to those questions, those of us that have the kind of training that I do, that it created a void. And that void, in my opinion, has been filled with inaccurate answers that mischaracterize shareholder capitalism. And that's part of what motivated me to write the book. That I thought we needed answers to those, and other people kind of filled in the answers. Even at universities, I would argue, if you go outside the finance department, you'll find answers to that question that I would argue are inaccurate answers. And I'll talk about some of the reasons why as I go on. At the same time, there's various what I'll call like corporate social responsibility frameworks are increasingly promoted as alternatives to shareholder capitalism. And what I mean by that, the way you can kind of think about all of these is so shareholder capitalism says, well, the goal of the firm is to maximize shareholder value. The goal of the firm is just to maximize the wealth of the owners. And the alternative to that would be, well, maybe that could be a goal, but the firm also should have other social objectives. It needs to have either like social or maybe environmental causes that the firm's trying to pursue instead of just shareholder wealth. That's the kind of counter argument to that. And so there's something called ESG, it's called like environmental social governance. It's a new way to rate firms. It's a way to rate firms on how well they're doing that. Something called stakeholder capitalism. Now people use the word sustainability. And here I'm being a little cynical, whatever new moniker they come up with next, because people keep having new kind of names for these. ESG is starting to get a bad name, so people are saying you shouldn't use that anymore. Let's just use the word sustainability. But anyway, so I think all these frameworks have in common is that it's the idea that it's okay for firms to pursue profits, but it should be these other things that firms pursue too, because there's problems with firms just pursuing profits. And I'm going to argue that a lot of these frameworks have their own problems, and they don't really come as advertised, and they don't make us all better off than shareholder capitalism will. That's one of the arguments that I'll make. And who is this book for? Really, anyone interested in the topic, hopefully. So the book, it's completely non-technical. You don't need a business or finance background to understand it. So when I wrote it, I was thinking of, who am I writing this for? Like I've old friends that I went to high school with, but they never studied or knew anything about business. I'm thinking, if I'm explaining this stuff to them, how would I explain it to them? They're intelligent, curious people, but they don't have the same background in economics or finance lingo. So that's how I wrote the book, and hopefully this talk is like that too. It shouldn't, we shouldn't kind of get. So professors have a bad habit. High school students might see this is we'll take things that are simple and we make them complicated, unnecessarily. So hopefully I wrote the book like hopefully I can take something that looks complicated but show everyone it's actually kind of simple. So that's what I tried to do here. So what I'll do in this discussion, I'll first make some points about shareholder capitalism, and I'll particularly drill down on some things that I think people misunderstand about it. So I said when we talk about we didn't give good answers to what does shareholder capitalism mean for non-shareholders, I'm gonna talk about some of maybe the wrong answers that people came up with to that and how to correct them. And then I'm going to discuss some issues with the various corporate social responsibility frameworks. So first I'll talk a bit about shareholder capitalism, why I think it's a good thing. Then I'll talk about some of these other frameworks. And I'll say, in the big picture, the case I'm going to make for shareholder capitalism is that actually it benefits all of society and everyone else. So the case I'm going to make is it's not that shareholders are special or they deserve things or hey they made good stuff they should get rich for it. That might all be true, but that's not the case I'm making. The case I'm going to make is that when people are pursuing profits, in order to get that profit, they have to do things that benefit everyone else, and it's those other benefits that create lots of good things for society. That'll be kind of like my overarching theme here. So first of all, let's talk about what is a profit? What does it mean for a business to make a profit? How does that happen? And so a business creates shareholder wealth by generating profits. An important point I'll talk about in a little bit, the business owner's wealth or shareholder wealth is not the same thing as your current profit, even though they're related, but I'll talk about that a little bit. And so a common fallacy is that profits come at the expense of other stakeholders, such as customers, suppliers, and employees. So people seem to have this idea like there's this pie called profit, and we need to decide how do we divide up the profit among everyone. And if the shareholders keep the profit, then everyone else gets something less. Or if a shareholder, if a business makes a profit, like off of you, you went and bought something for the business, it must be like they took something from you. Like they're better off with the profit, so you must be worse off. Like it's a zero-sum game. And that's not true. Business is actually a positive-sum game. It's not a zero-sum game. What a profit really reflects is mutually beneficial trading between the business and its stakeholders. And a way to see that is that a business, first of all, cannot command profits. You can start with the customer. So a customer only buys a firm's products if it benefits the customers. So today I went into, what's your coffee shop here? Nero, is that it? Yeah. So I went into a coffee shop. I go to Starbucks at home. I bought a cup of coffee, right? So I forget the price I paid, but whatever price I paid, the coffee was worth more to me than the price that I paid. And when they gave me the coffee, the price I paid was less than the cost of them producing the coffee. They made a profit off of me, but I also made a profit off of them. Both sides got something of greater value or we wouldn't do the trade. Employees only sell the firm their labor if it benefits the employee. So I work at Georgetown University, and I work at Georgetown because what they pay me and what they give me in benefits and in lifestyle is better than what anyone else will give me. Would I like them to pay me more? Sure, I'd like them to give me $1 million a year, but they're not going to do that, and nor will anyone else. But the basic fact is if we choose to work somewhere, it's because that place is what they're giving us is better than what any other place will give us or not working. So the choice to work there makes us better off. Suppliers only sell the firm their goods and services if it benefits the supplier, right? So for a firm to make profit, it needs customers to buy its products. It needs employees to sell them their labor. It needs suppliers to sell them their goods and services. But all those entities get to freely choose whether they do that or not. And if it doesn't make them better off, they don't do it. So pursuing profit actually forces you to do things that help other stakeholders. So I would describe a profit as a leftover. If you've ever taken any accounting, you see that a profit's at the bottom of the income statement. First you start with revenues, then you subtract the cost. So a business owner gets to keep the profits, but that's a leftover that the business created after making all the other stakeholders better off. Now that doesn't mean every time someone deals with a business they're happy. People quit their jobs all the time. Sometimes people go get a cup of coffee somewhere, they didn't like it, they go somewhere else. But in order for a firm to keep making profits over time and become a big and successful business, it has to keep satisfying a sufficient number of stakeholders because the stakeholders don't have to deal with the business if they don't want to in a market economy. Think of your own economic life. I know this doesn't apply to students, but when you get out of school, this will be your own economic life. You will trade with a business or some other institution for your income. So I work at Georgetown. I trade them my labor, they give me money. I take the money they give me, and I trade with businesses for everything I need in my life. Right? I trade with, for my food, my shelter, my clothing, my travel, my health care. And all of that trading makes me better off than everyone else, or we would stop doing the trading. Right? So all of our economic lives are like this. We trade with an institution for our income. We take that income, trade for all the things we need, and if those trades on average don't make us better off, we stop trading. And the fact we haven't stopped trading suggests that trading works. It's making our lives better, not worse. If it made it worse, you can just stop doing it. And so a big point here then is that a business cannot only benefit its shareholders. So that's one of the criticisms I hear of shareholder capitalism is that, well, you can't have like a type of framework that only benefits the shareholders and doesn't consider the other stakeholders. Well, it's impossible to run a business that only benefits the shareholders and not the other stakeholders because no one has to deal with your business if they don't want to. To create shareholder wealth, the firm must benefit all its stakeholders who are free not to trade with it. And it's the major business stakeholders that decide whether a business prospers or fails, not the shareholders. If customers get sick of a product, the firm is gone. If nobody wants to work at this company, it can't produce things. The company's gone. So it's the stakeholders. And a good way to see that is most new businesses fail to make profits and they're gone within 5 years. So if it's so easy to just start a business and command money from people, then why do half of them fail? And by the way, when they fail, no one's upset like that the shareholders lost all the money they invested to start that business. That's perfectly fine. It's only when businesses are successful that people start to question them. But the successful businesses we should celebrate because it's the successful businesses that have lots of other stakeholders that they're trading with and making better off, and that's a good thing. We should celebrate that. And when a business fails, it wasn't making other people better off, and it should fail. because it failed to make society better. So profits, it's a pretty good, I think, rule. And again, this is within the confines of we're obeying laws and regulations. We're not committing fraud. We're not deceiving anyone. So this doesn't say like go rob a bank, because robbing banks is profitable. This doesn't say like sell illegal drugs. So this doesn't say we shouldn't have some regulations that say you can't do this type of business because we think it's bad for society. That's all fine. This is just saying within those rules that it's good to pursue profits because you're benefiting other people. Now, another point I want to make is that people somehow tend to conflate shareholder value or the value of a business with short-term profits or profits immediately. And they say, well, this focus on short shareholder value, it's a short-term thing. It's myopic. We need to think of longer-term things. And that, hopefully, if you take Finance 101, you'll know that that's not true. So shareholder value is not the same thing as short-term profits. They're very different. And so some of the critics of shareholder capitalism claim that it encourages this short-termism in public firms. And short-termism basically means, and so here I'm talking more about not just any small business, but also especially like with publicly traded firms, right? So these are big firms that trade on the stock exchange. Is that what shareholders want is that they want firms to skip valuable investments instead of and just keep the short-term profits for themselves. So instead of like developing some new drug or some new technology or hiring more people, don't do that. Just take the profits and give it back to the shareholders. That's what some people claim shareholder capitalism encourages. And that's not true. The goal of shareholder capitalism is not to maximize current profits, it's to maximize shareholder value. So now we have to ask, well, what is shareholder value? Like, how do you measure that? So shareholder value is the value of the business minus any debt. So in a publicly traded company, shareholder value would just be divided by shares outstanding would be the stock price. So what's the value of a business? So I guess the simplest way to think of a business, okay, business is going to generate some profits this period, this year, next year, the year after that, the year after that, the year after that. So what we do, if you take Finance 101, we teach you, you just forecast all the firm's future profits, and those drive something closely related called the firm's free cash flow. And you just take we don't need to get into the technical details, but you just take the present value of all the future cash flow, which are driven by future profits, and that's the value of the business. Right? So it's not just the profit today, it's next year, 2 years from now, 5 years, 10 years, 20 years from now. So when people value businesses, like a firm wants to go public, they have an IPO, it goes public for the first time, that's how you value the business. You forecast all its future cash flow, come up with one number here at the end. And if you've ever done that, you'll see that long-term profits and long-term profit growth are far more important than short-term profits. What the firm's profit is today can really almost be completely irrelevant. Just such a small or not even no part of shareholder value. And so here's some examples to see that. As of September 21st, 2024, Microsoft's market capitalization. So market capitalization is just stock price times shares outstanding. That's also its shareholder value. Microsoft's was $3.24 trillion. Its most recent profits were $88 billion. So its most recent profits were less than 3% of its total worth, of its total shareholder value. So why would people pay over $3 trillion to own a company that but makes $88 billion? And the idea, and the reason is because when they come up with that shareholder value, what it's worth, they're not just looking at today's profits, they're looking at all the future profits. And so shareholders must think that Microsoft's going to continue to make profits over time, and that will grow. And that's what gives it a very high value today. It has little, if nothing, to do with its current profits. Another one is with IPOs. So in the U.S., if you look over the last 20 years, and I think this is just great for us or any economy, the majority of them were tech and biotech firms. So again, an IPO is you can have a corporation that can be public or private. A private corporation, they limit how many owners it can have. At some point, they might say, we want to raise more capital, so we'll go public, and then anybody can buy the shares, and the shares trade on a stock exchange. And so that's an IPO is the first time that happens. And so now, of these tech and biotech firms that went public, most of them were losing money. And that's why they had the IPO. So you think of a firm that's creating some great new technology, but the technology isn't finished yet, but it has to pay its engineers and all these other people money to keep doing this stuff. But they don't have any profits, they're losing money, so where do they get the money from? You could go to the bank, but you're not sure when this technology is going to work or if it will work, so the bank might not want to lend. But what you can do is you can go public and say, hey, if you want to own part of this business, you can become a shareholder. You give us some money, and we'll invest it in what we're doing. And if the company's successful, it could be the next Microsoft. And as a shareholder, you can share in the profits, right? So that's why that system's important. So anyway, most of these had negative profits, but their shareholder values were worth millions or billions of dollars. Why was it worth millions or billions of dollars? Because people aren't looking at the, yeah, talking to this? Okay. I'm normally really loud, yeah? Is this, okay, I'm talking to the, where was I? Yes. So a firm can be losing money, but still worth billions of dollars because people look to the future and think it will make money in the future. And when they take that into account, you get the value today. So a nice example is Moderna that made one of the COVID vaccines. So when Moderna came public in 2018, right, COVID hadn't happened. No one knew they would do that yet. Well, some conspiracy theories say people did, but I think, you know, I'll skip those. But it came public in 2018, and it was valued at $7 billion. That same year, they lost almost $260 million, and they didn't even have a finished product yet. They hadn't even sold anything yet, right? But it's still worth $7 billion. So why is it worth $7 billion? Because this shareholder value is a long-term thing. People look to the future and say, you know, maybe that company fails, but maybe it could make, you know, awesome new products that people use, and if it does, it'll be worth a lot. So I'm willing to invest in it and take that risk. And so that's another example. Now, and firms also regularly make investments that both lower current profits and increase shareholder value. So a good example, again, Microsoft this last year invested almost $30 billion in research and development. And if you know a little bit of accounting, when you invest in research and development, it lowers your profits pre-tax. So if Microsoft wanted to, they could have not made that investment, and their profits would have been almost $30 billion higher. But I would argue their shareholders would be poorer, not richer, because it would probably make their stock price go down if Microsoft just quit doing R&D. Because people would say, well, wait a minute, that R&D is creating your future products and your future profits. And if you just stop doing that, you won't grow as fast. And if you don't grow as fast, then you're worth less today. So shareholder value, it's a completely long-term concept. And so how do you maximize shareholder value? Well, you do that by making the business as valuable as possible. And the value of the business is driven by your future profits. So you need to make investments where the future profits exceed the cost of the investment. And if you take a Finance 101 class, we even have a word for it. It's positive NPV investment, positive net present value investment. So a corporate manager that's trying to maximize shareholder value, they're saying, okay, I can invest this money and it makes my profits lower today, but will it make my profits high enough, increase them enough in the future to offset that cost? And if it does, then we want to go make the investment. And so just some examples of investments that can create shareholder value. You can give your employees large raises and generous benefits because you want to retain good people and you want them to work hard. And if you treat them badly, they'll quit and they won't do a good job. So yeah, if you want to maximize, if you're you know, even if you're like the greediest person in the world, you don't care anything about your employees, all you care about is your own wealth, you still have a really strong incentive to treat your employees well because they don't have to work for you. Enter long-term contracts with suppliers that are good for the supplier. Improve product quality so you keep your customers buying your products. Develop new products and services that people want and need and make their lives better. Now, all of those can also be terrible investments. It depends, right? So that's the job of a corporate manager is to figure out which are good investments and which are bad ones. But in general, if you're, in order to create shareholder value, firms need to invest, and all those investments are going to include things that benefit other stakeholders. Has to, because those other stakeholders don't have to help out if they don't want to. I want to talk a little bit then about resource allocation. So what does the whole economy look like if you have a whole bunch of firms that are pursuing shareholder value and pursuing profits? And how does that look at the economy level? So the overarching problem of any economy is how do we best use scarce resources that have alternative uses? So if you take a economics 101 class at university, they'll usually define economics that way. What is economics? Well, it's the study of how society uses allocates scarce resources that have alternative uses. So we need to ask, what goods and services should we make? What should we not make? And what quantities, do we make more buses and fewer cars, more houses, fewer apartments? So how do we decide on all these things? And I would argue profits usually give us a pretty good answer. So a profit reflects what consumers are willing to pay for a good or service, less the cost of creating it. A profit means the value of what a firm creates is greater than the value of the resources that it used, right? So if I can take a bunch of raw materials and some labor and turn them into a product, and the price that I can sell the product for is greater than what it cost me to buy all the things to make the product, I make a profit, but I've also benefited society because I took things that were of lower value to society and changed them into things that's of higher value to society. And how do I know that? Because people were willing to pay me for it. That's not because some professor said so, but because the public said so, the consumer said so, the marketplace said so. And so, yeah, a profit means the value of what a firm creates to society is greater than the value of the resources that it used. Losses over the long run mean that a firm is not benefiting society. And I say long run here because in the short run, losses are fine. You think of like Moderna. Maybe they're just developing things and they haven't made their products yet. So in the short run, losses can be good if they're developing something in the future. But in the long run, if you're spending more than you're making, if the cost of developing your goods and services are greater than the price you can sell them for, yes, the shareholders are losing money, but you're also not really benefiting society. Because society says, hey, the stuff you're using is more valuable than the stuff you're making. So you should stop doing that. And the signal to stop doing that is a loss. And the signal to do more of that is a profit. The signal to go in the other direction is a profit. And so losses belong to shareholders as well, and they provide an incentive to stop using society's scarce resources towards things that don't benefit society. And so when firms are governed by profit seeking, so in a world of shareholder capitalism, there's a de facto rule that says only use resources to create goods and services that are more valuable than the resources being used. Right? If you can't do that, leave the resources alone and let someone else go use them. And so that's another reason why the profit motive is a good thing. And if you're not convinced of that, let's do a thought experiment. Let's imagine every firm strives for losses instead of profits. So the idea comes out that profits are evil, so it must be that losses are good. So how do you create losses? Well, use resources that society places a high value on to create goods and services that society places a low value on. So for example, I could take a nicely manufactured car and I could smash it up into pieces and sell the pieces off as junk. I took something society valued and I turned it into stuff society valued less. I would lose money by doing that, and society would be worse off because I took a car that someone could have used and took it into stuff that turned it into things that people don't have as much use for. If every firm did that for a long enough period of time, we would all be in poverty. That would be the end result of that. So going in the other direction takes us away from poverty. And how much time? Is there a clock? Okay. So I've talked for like half an hour. Okay, yeah. I can babble on and on, so I have to check on myself. But okay, great. So what's that?
25 minutes.
Okay, yeah, I think I'll do that. Yep.
Then we'll have a conversation.
Then we'll have questions. Okay, sounds good.
So we'll have a two-way conversation.
Okay. So now I want to talk about the idea. So now I've talked about, I think, some of the things that I think are good about shareholder capitalism. Now I want to talk a little bit about the idea that firms shouldn't really just be pursuing profits and shareholder value. Instead, they should pursue other things, other like various social and environmental goals. And the idea that corporations and businesses have this other social responsibility that they need to adhere to. So the critics of shareholder capitalism want the pursuit of social responsibility as the goal or a goal. And that includes various kind of monikers like ESG, I would say sustainability, stakeholder capitalism. All of these have that kind of idea. Now the firm, so again, in shareholder capitalism, and I'll make this point again, it's firms pursuing profits under the rules the government sets. So this is under the guise of, the government will set environmental and regulations and labor regulations. And within that framework, you try to maximize shareholder value, right? So this isn't saying like no government. There's a government there. But some people say, well, even with the government there, that's not quite right. You need to pursue these other social and environmental objectives. So it does sound nice, right? Like who doesn't want to be socially responsible? Like what do you have against businesses being socially responsible? What's wrong with you? We should all want to be socially, So what's the problem with that? Why, So the one problem I say right up is who gets to decide what's socially responsible? That's the problem with the word. It sounds like it's something that's very objective, but instead it's something that's completely subjective. It's entirely subjective. So people have very different views on what constitutes sound social and environmental policies, right? That's why we have elections. We don't all agree on that stuff. Now, I would say a private business or a private person, if you want to take your own wealth or the assets of your business and pursue a social or environmental cause, great. In a free society, people should be free to do that. Now here, though, in a publicly traded company with millions of shareholders, people probably aren't going to agree on what's a good or bad cause. And when firms start to follow those policies, people who don't agree with it are made worse off. And I would say even in a private company, it's not obvious that abandoning profits and putting resources to some other types of causes necessarily make everyone better. But I think people should be free to do it if that's what they want. So that's one problem is who gets to decide. This is a very subjective thing, and unfortunately the language makes it sound like it's very objective, but it isn't. So what ratings and labels reflect, so labels like socially responsible or sustainable, and ratings like ESG, I believe what they really reflect are just the labeler's preferences. So ESG is like a way to rate a firm on how well it does on, say, various environmental and social causes. But whoever made that ESG, a person made the ESG rating. So that just reflects that person's opinion of how well. So profits don't have that problem. A $2 billion profit is bigger than a $1 billion profit. It doesn't matter. Right? I think we can all agree on that. I don't think we would all agree on what's the ideal set of environmental and social causes we should pursue or not pursue. There's probably a lot of disagreement on that. So we shouldn't make a rating and pretend that it's something we would all agree on, like a profit is. The labels don't reflect society's preferences, and they don't reflect some overlooked economic reality. At least I've never seen that backed up. And it's important to remember, society didn't issue an ESG rating. Society doesn't call something sustainable. A person does. They're giving you their opinion on something. And you should interpret it as their opinion. Don't let them speak with this is some objective thing that everyone agrees on and that's the end of the discussion. These are very subjective things. I could create an ESG rating tomorrow reflecting my own views, and it's just as legitimate as the existing ones out there. What corporate social responsibility and ESG tend to do, they tend to promote policies that progressives favor, more on the left. I'm not arguing those are good or bad policies. I won't in the book, but they're partisan and they're quite subjective. And that's why in the US, I think 28 states right now have lawsuits against financial institutions or some type of legal, some type of new law to block financial institutions. So what was happening is people would work for say you work for the state, and the state has a pension fund, and the pension fund gets invested with a financial institution, and the financial institution tries to push the companies that it's investing in to pursue various ESG causes. And so some Democrat states like that, the Republican states didn't like it, but they were still doing it with their money, so there's lots of lawsuits over that. I'm not saying who's right or wrong. I'm not saying the causes are good or bad. I'm just saying they're obviously partisan, and they're subjective. They're just not things that people agree on. And when corporate managers pursue those causes, they force their shareholders to contribute to them. And I think it would be just as wrong if they pursued conservative causes. They shouldn't pursue either when you have people who think differently in investing in these companies. But empirically, it's mainly been following causes that progressives favor. And even among ESG, this rating scheme's proponents, there's no consensus on what to measure or how to measure it. And just so students and some people who don't know what this is, what ESG really does is they'll take a firm and they'll rate it on how well it performs with respect to the environment, society, and governance. And there's at least six major ones, and one study showed, and not surprisingly, that they don't even agree with each other. So the correlation is very low. The six all never agreed on a company's ESG rating, and in most cases there was little agreement among them. I think they're all still trying to push things in the direction that maybe more progressives like, but even doing that, there's disagreement on how to best do that. And so now I want to talk a little bit about ESG or some of these other things can be a correction for regulatory failure. So what is a regulatory failure? A regulatory failure is this. It's something should be regulated, but for some reason it is not. And this is like a common argument for ESG in academia. So can ESG, so here's the idea, like, firms are doing something that I think is harmful to the environment. And that should really be regulated. But it isn't regulated. Why isn't it regulated? Well, the regulatory agencies aren't working the way they're supposed to be. So that's wrong. So this ESG thing, we're going to give firms a bad ESG score for doing that, and that'll be an incentive to fix them, to correct that. So ESG can be like a de facto regulation. So what's the issue with that? Well, one issue is that if a regulation that some people favor is not part of the regulatory code, that doesn't mean there's a regulatory failure, right? Regulations have costs and benefits. There's always a trade-off. So if something is unregulated, I would argue the more likely scenario is that most people want it this way. Most people don't want it to be regulated. So the regulatory environment, the regulatory failure thing, I hear it, actually, you hear it a lot in academia, because academics all kind of think alike, and they think everyone thinks like them. But if you go outside of academia, actually, a lot of people sometimes think differently. And so maybe that's why it's not in the regulatory code. And so, people can just have different opinions on things. And so, and it's worth, when I wrote the book, I'm like, I want to dig into that a little bit. Like, because, people will say, like, well, it's a regulatory failure. It's hard to regulate things. I'm like, is that really true? I don't know. I need to go dig into it. Like, how hard is it to regulate? And so our US regulatory code, I found there's a university, George Mason University. And what they, they have a computer algorithm that reads through the US regulatory code to tell you how many restrictions are in the code. And the reason they had to make a machine learning computer algorithm is that nobody can use, at least in the US, nobody can read the regulatory code. It's too long. So our regulatory code, the Code of US Regulations, is just the federal, has over 100 million words. And according to this algorithm, if you count all the restrictions, all the things you're not allowed to do according to the code, there's over 1 million. The Environmental Protection Agency has issued the most. And it's just in its own code, so that's which is part of the US regulatory code, there's 170,000 restrictions. So if you're running a business, the Environmental Protection Agency has 170,000 things that you're not allowed to do. And states regulators, and they've averaged over 3,000 new ones per year since they were founded in 1970. States regulate as well. So just the state of California has over 400,000. I'm sorry, I don't have data for the UK, so maybe it's better here. But my point is, even if you're a corporate manager and you want to maximize shareholder value and you don't care at all about the environment, it's still the case you have to take environmental things into consideration when you're making your decisions, because there's a regulatory agency that'll back that up if you don't do it. And by the way, I think you should have to follow all of those. I think it would be better if they could make a shorter list so everybody could read it. But yeah, shareholder capitalism says you need to follow the rules. And if that's what the rules are, you have to follow them. But my point here is it's not like there are no rules out there, or it's not like they have such a hard time adding rules. They add 3,000 new restrictions every year. So they can set the rules they want to. Maybe not all of them, but they can set a lot of rules. So the New York Times partnered with George Mason. This was back in 2017. And they just wanted to ask the question. They're like, okay, inside those 1 million restrictions, how many would apply to an apple orchard? Like you just want to run, apple orchard. We just want to run an apple orchard. And the estimate they came up with, according to the computer algorithm, was 12,000. So in the US regulatory code, there's 12,000 restrictions, 12,000 things that say this is a rule or a restriction you have to follow if you want to run an apple orchard. And some of the things were like, well, if deer come to apple orchards, and sometimes deer, they have droppings on the ground, and you might step in the dropping, and it would get on your boot, and then you'd slip when you step on a ladder. So you have to look for deer droppings every day. Like that's literally in the US code, according to the New York Times article. So there's 5,000 restrictions written just for orchards, and another 7,000 that apply to orchards and other businesses. And again, as far as shareholder capitalism is concerned, you got to follow the rules. So we're not telling people what rules to follow. I'm just pushing back on the idea that there are no rules out there, or it's so hard to make rules that businesses have to follow. But as far as shareholder capitalism is concerned, within those rules, you should try to maximize shareholder value. Whether that's too many rules or too few, that's a different kind of argument outside the scope of my book. But there's plenty of rules out there. And so why do we need additional ESG rules or additional rules like this? And I think the answer is some people want stricter and additional rules They can't get them democratically, because ultimately regulatory agencies answer to politicians, and politicians do put some limits on what they can do. So there might be some rules out there that people want, but others don't. So regulatory agencies can't do it. So what they do then is let's invent ESG or some other moniker and try to get firms to go along with the rules this way. And so what it really reflects is just unelected persons trying to have an outside say in how corporate assets are used and how society is regulated. That doesn't mean they have bad ideas. Maybe the people promote, maybe these rules would be better rules. I don't know. But in the end, if everyone really wanted those rules, certainly regulatory agencies could do them. It's just the people we're electing step in and say, no, you can't go that far. So government regulations, right, although imperfect, they ultimately come from elected officials. If you don't like the way your government regulates you, you can vote for different politicians. So let's say ESG becomes an effective rulemaking scheme. What do you do if you don't like your ESG regulations? Right? You can't vote them out of office. So what set of rules do we want firms to follow? The rules that our government makes, which might not be perfect, but at least we elected those people, or rules that these kind of ESG type rules. So the last thing I'll talk about then is a very controversial one right now, is who should make fossil fuel policy. And so what's gone on here, and I think this is like a good example, at least in the US, it might be different in the UK, but in the US, I think this is a really good example of unelected people working in the finance industry trying to be regulators, trying to force a regulation on society that most people don't want. I think this is a good example of that. So the Paris Accord, most of you probably know this, calls for net zero CO2 emissions by 2050. Currently in the US, it's not a law or binding regulation on any US firm. So the way it worked in our country is like Obama signed this, but it wasn't ratified by our Senate. And so therefore, it's kind of not binding. Presidents can sign things, but it has to be right. So kind of Trump unsigned it, Biden re-signed it, but the Senate, our Congress and Senate haven't ratified that. So in the US, you can make as many CO2 emissions as you want, and you have the right to do that for now. Nonetheless, though, some asset managers, along with the United Nations, and by the way, ESG comes out of the United Nations, working with financial institutions, and the World Economic Forum are trying to force firms to comply with it. And so how does this work? So again, now here we're talking about things that really only apply to publicly traded companies. So investors increasingly own shares through investment funds. So I'll give you an example of how this works. Part of my paycheck every month goes into a retirement fund. It goes, and it's invested with a company called Vanguard. Vanguard then takes the money I gave them, and it gets put in one of their funds, and their funds invest in hundreds of different stocks. So I kind of own those stocks, but technically I own the Vanguard fund, and the Vanguard fund owns the stocks. So Vanguard's the shareholder of record for the stock. So what that means is that when you own shares of stock in a corporation, you get to vote on various things. So when voting comes up for stocks in the Vanguard fund, like let's say ExxonMobil wants to vote on something, I own Exxon indirectly through the Vanguard fund. I don't get to vote. Vanguard gets to vote. And because so many people invest through fund managers nowadays, the fund managers control so many shares, they get to decide who gets to sit on corporate boards, and the boards kind of make the rules of how companies operate, and also on really important corporate policies. And so what the fund managers have done, this is working with the United Nations, is they formed a couple consortiums. One is the Net Zero Asset Managers Initiative, and the other is Climate Action 100. And both of these consortiums, their goal is to get the businesses they invest in to comply with net zero 2050. Zero CO2 emissions by the year 2050. I'll also say with Vanguard, Vanguard's the third or fourth largest asset manager in the world. I gave this talk at Vanguard too. So I had always invested with them. They were a signatory to this, and I didn't know. So I would argue, my point is that most people who invest in these funds, I think, have no idea that the funds are doing this. So I was invested in Vanguard. Vanguard is a signatory to that. And what that means is that you agree to pressure the companies you're investing in to comply with net zero 2050, which is not a law or regulation on any US firm. Vanguard actually pulled out of that, though. So Vanguard quit it, and Vanguard said, and the reason I gave a talk there, I talked to them about it. They said, our goal is to we're an asset management company. Our job is to get our investors the best possible financial return. we shouldn't get involved in public policy things. Those two goals conflict, and we're going to pull out of it. And so they pulled out of it. But many of the biggest, like the largest in the world is BlackRock. They're still in it. Many of them are still in it. So the idea is basically, these guys want to kind of act like de facto regulators. Firms don't have to follow this net zero 2050 regulation, but let's try to pressure them to do it anyway through corporate voting. So I would argue if U.S. voters wanted that, it would be one of the 170,000 EPA regulatory restrictions that we have. We don't have that because most people don't want it. And so what the fund manager consortiums is they're an example of unelected persons trying to regulate. Now, maybe again, in academia, what I hear is maybe the fund managers are better informed and the voters are just ignorant. So fund managers are doing us a favor. They're doing a good thing. I mean, that might be true. A couple points I'd make. If the US and Europe do net zero 2050 alone, it matters actually very little for global temperatures. And that's because over time, we're becoming much less important with respect to CO2 emissions as China and India and Asia become more and more important. So it really matters if the whole world doesn't agree to do it together and just a few countries do it alone, you're probably going to end up with the same temperature. Now, that said, what would happen if the whole world enacted net zero 2050? Like, let's say we all agreed to do this and we did it perfectly. There's still some research out there that says it's not a good idea. And again, I'm not saying this research is right or wrong. My point is just, as a voter, if you don't want net zero 2050, you're not ignorant or crazy. There's some pretty high-level people who do research on this who say it's a bad idea. So William Nordhaus has a Nobel Prize in economics for his work on climate change economics. He wrote a 2018 paper, and he says, well, first, let's estimate so you're looking out in the year 2100. Let's estimate the cost of climate change, right? And let's also estimate the cost of net zero 2050. According to him, net zero 2050 cost a lot more, several orders of magnitude more. You're better off just dealing with climate change. He says ideally you kind of do something less aggressive than net zero 2050. That's the optimal. But if you have to pick between that or nothing, he says you're better off doing nothing. And actually in his paper, he calls it technologically infeasible. Like it's not even something you could do if you wanted to do. Now, Richard Toll, I think right now is the most highly cited climate change economist in the world. He did a meta-analysis. What that means is you take the results from 39 different studies and you kind of weight them together and see what it tells you. And he said, and what he shows in this study is that even if you did net zero perfectly, like you did the most efficient, most efficient CO2 emission reduction strategies you could possibly think of, it's still the case that net zero costs are much higher than climate change costs. I mean, much higher, like several orders of magnitude higher. We can keep looking. So many studies put how big are the costs of climate change expected to be? And again, these studies might be wrong. I'm not saying you should disagree with them. My point is just if you're a voter who isn't so convinced of this, you're not crazy. There's a lot of good research out there that backs that up. Maybe the research is wrong. I don't know. I'm just pointing it out here. Many studies put the cost of climate change, again, by the year 2100, not now, 2100, at about 2% to 3% of GDP by 2100. So in 2018, the UN's IPCC report said by the year 2100, climate change would cost 2.6% of GDP. To put that in perspective, the economy grows at 2 or 3% a year. So it's like basically 1 year of economic growth. The Biden administration, which is very in favor of net zero, but their Council of Economic Advisors released a study. They summarized 12 other major studies on the cost of climate change by the year 2100, and the consensus estimate is about 2%, a little under 2%. So that's something. That doesn't mean it's not, but it's definitely not the apocalypse, right? 1 year of growth is not the apocalypse. A 2023 study by MIT researchers estimates the Paris Accord policies will cost between 8 to 18% of GDP by 2050 and 11 to 13% by 2100. So again, we're comparing, right away, maybe even 18% of GDP to what right now is much less than 2% of GDP and maybe grows to 2% of GDP. New Zealand actually decided they would go along with net zero 2050. That's government policy. But they have a report that's not widely publicized that estimate is going to cost them 16% of GDP by 2050. So again, my point here is that I'm not saying what the policy should or shouldn't be, but my point is that in the U.S., it's I think not a policy, not because there's some regulatory failure, but because people recognize it's very expensive, and they're not as concerned about global warming as others are, especially in academia. So we did polls. Polls are funny. So if you ask people, do you think corporations should do more to fight climate change? They'll say yes. But if you ask people like, would you pay $10 a month to combat global warming? 68% of them say no. Maybe they're wrong. Maybe they should pay a lot more. But people, for whatever reason, that's what they think. A Kaiser Family Foundation poll found 71% of, this is with Americans, and it might be very different here. I'm not, I don't know what people would say here, that won't pay a 10% month tax on global warming. And of course, if you do like a net zero policy, it's going to make things more expensive. If you make energy more expensive in the short run, everything else becomes more expensive. So people are, it's not just corporations are going to pay for that. A lot of other people will pay for it. And 74% were opposed to a 25 per gallon gasoline tax. And I can say we're having an election right now, and this is not an election issue. No one's talking about global warming. They're complaining about high gas prices, but no one's, it's just in our country, it's not something are that upset about. Now, what I would say is if voters want net zero 2050, they should have it. So even after hearing all that, let's say, you know what, I don't really agree with those studies. Maybe they're right, but this global warming thing worries me. I want net zero 2050, and enough people want it, then fine, you should have it. But my point is that I don't think fund managers should be forcing it on various countries, right? It's one thing if voters want it. It's another thing if voters don't want it, and then fund managers form these consortiums and force them on everyone else. And I think a bigger problem with those consortiums is once they're done with global warming, they can go on to other stuff. So if we can force firms to comply with this net zero 2050 thing, we can force them to comply with other things. And do you really want fund managers doing that? So who do you want setting your policy? Do you want fund managers to set policy, or the government that that you elect and has to answer to you? So I'm about out of that. Well, I have 5 minutes. This will take like 5 minutes. Yeah, and this will end it. This will be the last thing I'll say. Is how do we? So I want to go back now and just put the two things together and like how should you think about the social value of a business or of business in general? Like how do we tell if business is doing a good thing for society or not? And I talked about this some. I want to end on it a little more. So one thing that's important, of course, is global poverty and reducing it. And we've actually done a really awesome job at this. You can always do better, but this is pretty cool, I think. In 1970, 45% of the world, this is World Bank statistics, lived in poverty. Today, it was 8%. And not only did we reduce the percent of people living in poverty, but the world's population more than doubled. So back then, you have like 3.5 billion people, 45% live in poverty. Today, there's over 8 billion people, only 8% live in poverty. It's pretty awesome. So what caused that reduction? How did we do it? What's kind of interesting, if you go back to 1970, the same institutions that are promoting the idea that shareholder capitalism is bad and you need to replace it with ESG and other things were telling the world the reason we had all this poverty is because the world was overpopulated. There's too many people in the world. This is back when there's 3.5 billion people. And to reduce poverty, governments had to limit population growth. They even said economic growth itself was unsustainable. So the original sustainability thing was that economic growth is unsustainable. You're using too many resources. We need central planning to control how many resources can get used because we're going to run out of resources. And it's this whole other thing. But actually what that led to is millions of forced sterilizations and even abortions around the world. So like the World Bank, which is a lens for poverty, lent millions of dollars, in particular to one campaign, like one sterilization campaign in India in the 1970s, they sterilized 6 million people and forced to sterilize them. Like if you want your food rations and other stuff, we're going to sterilize you so you won't ever have kids. And China, of course, people heard of China's one-child policy. That came out of this. Maybe hard to get estimates there, but I mean millions of forced sterilizations and abortions, all with this idea that the only way to reduce poverty is have fewer people, and then we can split the stuff up more. Then there's less stuff to be split up among more people. So that's what in academia, many famous academics were promoting that. So kind of the same people who were promoting, kind of the same institutions promoting net zero. We're promoting this thing if we just go back, but you never hear about this, which is strange. But that's what was going on up until really the 1990s. And so, as an example, here's a quote from the World Bank president. So this is Robert McNamara. He was president of the World Bank, and so students who don't know, the World Bank gives loans to poor and developing countries in exchange for maybe they can change their policies and grow. He said, short of thermonuclear war itself, population growth is the gravest issue the world faces over the decades immediately ahead. Indeed, in many ways, rampant population growth is even more dangerous and subtle threat to the world than thermonuclear war, for it is intrinsically less subject to rational safeguards and less amenable to organized control. So that was the way of thinking, Ben. So this is World Bank president. He's World Bank president for 13 years. So that was the kind of thinking back then. There's this impending environmental disaster coming up, and we all need to be doing things to fix it. And the thing we should be doing, according to them, was sterilizing poor people. Rich people didn't get sterilized. And so now really these institutions that were promoting this stuff, they were proven wrong. And how do we know that? Because population grew from 3.5 billion to more than 8 billion, and poverty fell. And so what they did then is they redefined sustainable and moved on to things like global warming and ESG and other things, and let's just forget about what was said, over the previous decades. So what did cause the poverty reduction? And so I would say it was primarily reforms in China, India, especially in China. That's where we got the most people out of poverty, that encouraged more capitalism. Profit-seeking firm businesses created wealth, goods, services, and jobs, and they did that in these developing economies just as they do in the US and Europe. So China was a communist country that became a capitalist country, and then people got wealthy and the economy grew. The other thing they don't teach you in school is that the communist governments killed probably 100 million of their own people. But for some reason we don't talk about that. But that also happened in the 20th century. But so China stopped doing that. It became a capitalist country, and millions of people got out of poverty. And they weren't pursuing, they didn't have an ESG rating or any of these other things. They pursued capitalism, a form of it. Maybe not exactly like here, but more capitalist than it was before. You might notice that a wealthy nation is full of profit-seeking businesses. A poor nation lacks them. So why is that so? So as I said earlier in the talk, profits reflect wealth creation for shareholders, earned by mutually beneficial trading with customers, suppliers, and employees. Shareholders, customers, suppliers, and employees are all members of society. So you don't need some third party with a rating scheme saying what's good or bad. If we're all just agreeing to trade with each other, we're making ourselves better off, and we're making our kind of lives better. So no institution or anything should ever take credit for that. It's just something we all do among ourselves. And so if you think of the average person's economic life, they trade with a business for wages, like I said at the beginning. They use those wages to trade with other businesses for things like food, shelter, clothes, computers, and so on. Those trades make them better off, or they wouldn't continue to do them. Without this trading, if all these businesses disappeared, we would all live in poverty. I think that's a pretty good definition of poverty. Go look at parts of the world where there's still poverty and ask yourself what's missing. And what's missing is they don't have a vibrant private economy with businesses growing and creating goods and services that people want and need, and jobs and everything else. That's what's missing in those places. And so I would say that this mutually beneficial trading, that is the social value that a business creates. Right? The fact that a business is doing well means it's making again, following rules and regulations. I think that's the best way to think about the social value of a business. And so I think that is it. So thank you for listening. Yeah, thank you.
Wonderful. So we'll just have a little conversation. I'll
Sure.
start us off with a couple questions, and then we'll open the floor. So thank you for laying out the case so clearly. And I think this is particularly important because there's so much conversation on the redefining the purpose of the corporation. And in particular, your emphasis on not thinking about things as fixed pie and recognizing the degree to which economic growth has been responsible for the extraordinary reduction in poverty is very important. But let me push back on a couple points that you made and see where we go. So the first thing is that it seems like almost your entire case is hinges on thinking about shareholder value in a long-term way, the way it's defined. Mm-hmm. The problem is, as we often say in economics, in the long term, we're all dead. And in fact, in reality, we are often tussling in companies between the maximizing quarterly earnings, right, compared to actually the things that we'll call shareholder value to rise in the long term, because the people whose incentives maybe to maximize shareholder quality is not the ones whose incentives broadly are to think about long-term value. That is what causes a lot of the problems that we see in companies. So how do you resolve that? Because that seems still consistent with shareholder capitalism and what we see going on now.
Yeah, so I would characterize that a little bit. Somewhat isn't. So I think what you're saying is like, so let's say I'm a corporate manager, and my compensation depends on me meeting a quarterly earnings number.
Yeah.
And I have this good investment over here, but if I make the investment, my earnings will be lower, and I won't make that number.
Yeah, that's one part. That's one way in which the pressure comes.
Yeah.
The other pressure comes from, there's many ways in which you have quarterly profits affecting company decisions.
Yeah. So that's one way. So I would say in that way, I would call that then an agency problem. So that manager is then, if they don't do the investment that's ultimately good for shareholders, and they have higher profits in the short run, that's a manager not really. That manager isn't obeying shareholder capitalism. They're out for themselves in this point. So I would say like maybe better compensation contracts or something like that would be a way to resolve that. So I think what you're saying too, and I'll push back on this a little bit too. So I think what you're saying is that firms also under shareholder capitalism, there shouldn't be any fraud or deception. Right?
Sure. Yeah.
So if a firm, let's think about it. Let's say a firm tries to beat a quarterly number, and it cuts a valuable project, and people don't realize it cut a valuable project just to make a quarterly number. It's a little bit of a deception there. It's a bit of a So
no, it definitely wasn't. There's that going on for sure. That's happening, but that's not that's not what I'm talking about. I'm talking about treating your workers better or trying to. So I'm actually going to do something very unusual for this setting. Okay. I'm going to call on some of the experts in the room here for a second to have the conversation, because I think this is a very important conversation. Sure. And Nick Dalton is here, who's thought about this who's been, for example, at Unilever for 30 years. I'm sorry to call you out I'm doing the cold calling from my HBS days. Nick, could you tell us a little bit, because actually your views on this have shifted my views on this. If you could tell us a little bit, and if we can bring a microphone to Nick, but you can just sort of speak loudly.
By the way, I love the presentation.
Oh, thank you. Yeah.
You've raised my blood pressure, but also you've stimulated my brain.
Okay. Yeah.
So I want to give you, see how you frame a real example.
Okay.
Because I think the example you just used there with Nava is not a real one.
With which one?
With the deception.
Choice one.
Okay.
Most big businesses, anyway, have a hurdle rate 15%. So, that's not the real world. But let me give you a real example. You're a mature business operating multinationally.
I'm going to stand up. Sorry.
Yeah.
Okay. Operating multinationally.
Yeah.
In largely mature markets.
Yeah.
Okay.
You're in a country with lax labour regulation.
Okay.
Where the labour market is predominantly run by gangmasters.
Okay.
Yeah. Who are skimping off wages of the people they provide the company as an agency.
Okay.
And this is how the whole economy is actually run.
Okay.
I'm not going to give you the country, but it's a real example.
Okay.
Managers in that country, in order to be able to meet the demands of the centre, have to run their business against the norms of that country. Otherwise, they go out of business. There's no business in that country.
Okay.
Because you've got lots of local companies, you've got lots of multinationals. So that's the system they're in.
Yeah.
Now, in that system, you've got the bizarre situation when you take it up a level, especially if you're making a brand. You're not paying your workers enough to buy your own product.
Okay.
So year on year, systemically, your market is getting smaller. And it's getting smaller, not because of consumer choice, but it's getting smaller because of the structure of that labour market.
Okay.
What do?
Well, let me ask you this. What would happen to the people who work for you if you left the market? Would they be better off or worse off?
No. You would just continue with the race to the bottom.
Right. So what I'm saying is that I'm not totally sure the question, but...
Well, the question is, what do you do? What action do you take as a corporate executive in that situation where you can see systemically the structure of the labour market means you cannot grow your product, you cannot grow your top line, and you're in a race to the bottom in a mature market. in a country, which, by the way, most countries in the world are like this.
Right.
They're not like the USA or the UK or Europe. Most countries in the world, in the developing world, Africa particularly, Southeast Asia, have labour markets that are fundamentally flawed. They're not free markets.
Okay.
You're in that situation. What do you do? What do you do to maximise shareholder value here?
So what would happen if I just operated in that market? So I'd say two things. If I operated in that market, the way that market operates, I would still say that's better than me not operating in the market.
But you're going to end up in a situation where you're out of business in that market. Is that good for the shareholder?
What's that?
You're going to end up in a situation where you're out of business in that market. Is that good for the shareholder?
How do I go out of? I don't get how.
You mean that? Okay. So I think
Because
what's happening
ultimately,
is that
your margin is falling because you're not getting growth. These are the real situations. Now, Henry Ford dealt with that in the 1920s by giving his workers a pay increase because he was in a duopoly.
Yeah.
We're not in a duopoly here. We're in a real market in a big country where the structure of that market means to maximise shareholder value, you're going to fundamentally, year on year, undermine your business.
Well, then you're not maximizing shareholder value.
So what do you do? That's why I asked you.
I would maximize shareholder value. I would take the strategy that maximizes shareholder value.
So what would you do?
But, so first of all, I'll push back on one thing. What one business pays people in a market isn't going to put you out of business because you don't set the wage in the whole market.
I'm asking you, what would you do? That's the problem. You don't set the wage in the whole market. So what do you do? What is your strategy here?
To maximize, I would try to maximize shareholder. I would pick the strategy that maximizes shareholder value.
What would you do? Would you pull out of the market? Would you lobby the government to try and increase the wages? Would you unilaterally increase the wages yourself? What would you do?
I don't know what I would do.
No, that's the point.
But my point is, I'm not sure you know what to do. I'm not sure. What you're saying. Here's what I'll say. It's not clear to me that I think you'd still try to maximize shareholder value.
I think what's hard here, let's just frame this in the because I think actually it's also really important for all the high school students that are here, is that we can have, exactly like you said, we can have theoretical frameworks, okay, and we can have people talking about it, and then you have the sort of what's really happening on the ground.
Yeah.
And Nick is talking from the position of a manager who had to think about this.
But I'm not sure that contradicts. I'm not sure that contradicts.
But so I think what it sounds to me like what you're saying, David, is that, you know, are you doing something that's better than what the alternative would be for those workers?
So I would say if you're there, let's just say you're there and you operate the way they tell you to do it, and let's say you operate the way that maximizes shareholder values. As bad as it is for the workers there, it's still better than you not being there, or they wouldn't work for you unless they're slaves and they're ordered there. But if they're, and of course we don't, you know, this is people freely agreeing to do things.
Okay, so let's hold on this. We'll
So
talk
just one thing,
afterwards too.
sorry. Why not try and change the system?
And then let's.
Because it's not your system. Because they might not care about
All
your
right,
Western.
let's go back
Wait a
to
minute. Let me tell you something. This didn't change with your system.
Yeah.
China didn't pull millions out of there because Westerners told them what to do. Right?
Okay,
That
so-
didn't happen because of your system.
So I think part of what we're talking about is when you have the need to maximize profits, but those may not coincide with things that you might want to provide in a situation like in a multinational where in your country you have certain regulations, you don't have them in other countries. So that's part of the trade-off we talked about with short-term profits and long-term shareholder value, which is very challenging to put into place. Part of the solution was create the right incentives, right, and not have the agency problems that you talk about. I guess the second thing I wanted to raise was in thinking about, I'm so with you on how problematic the ESG measures are, and those as a fix create enormous other problems because they're terrible measures, and we're actually much better off using the objective measure of profits and prices because they actually contain knowledge from everyone else. And the problem of overregulation, which you clearly pointed out here. But there have been some really interesting work, I would put in this category, things by Luigi Zingales and Oliver Hart recently on other types of ways in which if shareholders care, for example, about environmental benefit, let's say, And they get together and they talk with the company about that. And maximizing shareholder value involves, for example, some environmental benefit. There may be ways in which companies have then the incentive to innovate. And in innovation, they actually find ways. So this is not through regulation, right? This is through a different lever. They find ways that actually they would be much better in creating the environmental change than having to comply with some regulation or doing something else. So they're actually well positioned because of the way in which their particular strengths.
Okay, what's an example of that?
So an example is any company that basically, for example, think about supply chain companies, right? And then they are able to innovate on the way they design their supply chain.
Okay.
That they have an ability to do that. That if they, for example, maximize profits and then sent the money back, would actually not have the same
that's not maximizing.
impact.
First of all, that's not maximizing shareholder value.
Well, so this goes back to the first question, which is how long term is your shareholder value?
It's certainly not. It's not current profits. It's the future value about I have a textbook. My textbook has a quote in it that says you could invest in a green energy project that isn't profitable for 20 years and it can increase shareholder value. So I think it goes pretty right. So this doesn't rule those things out.
Yeah. So how do you? So that might be the right question then. Imagine that's right.
Right.
Okay. And so what you want to do is spur innovation, and I don't just mean R&D. I mean all kinds of ways for everyone in the firm to be thinking about that, creative ways to sort of reach that long-term.
Well, who gets to say what those long-term things are? So I think that's the problem. So here, when I'm maximizing shareholder value, who gets to say what the long-term things are? People, and I say this, well, let me say a couple things. With maximizing shareholder value, customers decide if they want to buy the stuff. Employees decide if they want to work, even in poor countries. Most employees get to do that. Suppliers decide if they want to supply you. So a corporate manager is kind of governed by all that stuff, and within all that tries to maximize shareholder value. Now if we just say, well, the corporate manager should pursue other environmental causes, well, who gets to say what those causes are? How do we know they're good causes? Well, why would we think corporate managers are good? Who gets to say what's a good cause? Who gets to say if the money we're spending on the cause is worth giving up whatever we're spending that money in? If you spend money pursuing environmental causes, you didn't spend that money on something else, like creating goods and services and jobs and other things. And then some people say, well, if you spend money on environmental causes, it'll also increase shareholder value. Well, great, then do it. Then there's no argument. If they're the same thing, then they're the same thing. We only have some tension when they're different. Yeah.
Or if they're short versus long term.
Yeah, it's not the short isn't invented. I don't think that didn't. I don't think the short term thing is a. I don't think that's. I think that's kind of an.
So because I think the question is, what if your shareholders actually care about environmental impact?
Good. Yeah.
And should you then, as a company, pursue, for example, technologies that have less emissions, even if that's going to create a little bit less profit?
So I would say in a publicly traded corporation where not everyone agrees on that, I would say no. So I would say it is not always better to have less emissions. If you reduce emissions, there may be benefits. There's certainly cost, and different people can have different opinions over the cost and benefits. And the person who wants the least emissions isn't the person we should think is right. And that's what a lot of this stuff does with it. With the environmental things right now, it's whoever wants the most extreme environmental policy and talks nothing about cost. Because I'll say that a little bit, and like in our conversation, you're talking about all the technologies and all the things we can do, but you don't talk anything about what those things cost.
Sure.
Those things cost, we're giving up something for that. And so why is it always the people, so what a lot of ESG is the people with the most extreme point of views that most of society doesn't have, want their own types of regulations, their own types of kind of development that other people don't want. And why do we have to go to that? That's what I
think that technologies and innovation are things where they are going to have profits for the firm. They're going to create more productivity, but they do cost something in the short run. All right, let's open the floor.
Then I would say do them. If the long run, that's again, you take a Finance 101 class. Every investment we approve, it's something in the long run, in the future, offsetting something in the short run. And I guess one other thing I'll push. I don't think we can say, oh, here's a new technology and it'll make things better in 30 years. That's pretty speculative. But if people think that, if a manager thinks that, then invest in it, but convince everyone else that that's true.
Yeah, and then exactly, then it becomes an implementation challenge.
You got to make your case that you're right.
That has to do with aligning incentives and that kind of thing.
Yeah, and convincing people you're not wrong in wasting their money, because maybe the manager's wrong and this is a silly thing to spend money on. Right?
Okay,
just because we call it sustainable doesn't mean we should do it.
All right, let's open up the floor. There's lots of questions. Why don't we take like 2 at a time, 3 at a time? Go ahead. And maybe actually just introduce yourself, or just say that if you're a student here, or if you're...
Hi, my name is Lena. I'm a PhD student at SOAS. I have 2 quick questions. So one is, how does this, because problems of global public goods, public goods is a problem, like a challenge for regulation. And I think what you showed here with emissions, for example, it's not just 2% cost for the US, it's very much different costs for other parts of the globe. So there's a contradiction there, and I wonder how you would answer this with shareholder capitalism?
Yeah. So that answer, the 2%, that's a global estimate. So from those studies, so those aren't US studies. So those are studies that said, one of the 2 ends is from the UN, IPCC. So what those studies say is of global GDP, if you look at it the year 2100, what do we think it'll cost? And UN and others come up with 2 to 3%.
But that's probably business cost calculation.
No. That's the cost to the total all society, total economy. Yeah, no, not to businesses. Yeah, but what shareholder capitalism would say is that if you want to regulate it, firms have to listen. My point was that fund managers shouldn't force firms to do it if voters haven't voted for it. But shareholder capitalism say, if that's what you want and you convince enough people and you vote for it, then that's what firms should comply with it.
Yeah, if those are your preferences, that's maximizing shareholder value. Yeah. We have a question here and here. There's a few questions. Let's take a few here. Go ahead.
Can I quickly point out having a PhD in environmental economics, so maybe being slightly biased.
Yeah.
The estimates you presented are global costs. So 2 to 3% is world GDP.
Yeah, so, yep.
The estimates you presented at national level are national GDP. And so 16% of, if you go back to your slide, the 16% that you referred to is just national GDP. And so really the estimates are quite different when you're comparing that 16.
No, so that's just for New Zealand. Richard Toll's study, the MIT study.
Exactly. So that's 16% of national GDP in New Zealand versus 2 to 3% of global GDP that we're comparing.
Right. These are global estimates.
The higher part, the MIT study,
the MIT
yes,
was
and then there's confidence intervals, and then there's, there's a lot more uncertainty.
I'm not saying I know which it'll be, but I think you have more certainty over the cost than you do the global warming cost.
The current cost, yes, but then there's an aggregation issue where if everyone committed, the innovation that would come out of it is a lot more complicated to establish, right? Because now you'll be changing the incentives at global level.
Okay. Let's take a few questions at a time. We have one here, one here, and here. Do we have mics on the other side? Just one mic. Okay, we'll bring it around. Yeah. Go ahead. Let's take like 3 questions, if that's okay, David, and we'll write them down.
I'm Basma, and I'm a 6th former, but I had a comment on how you say that shareholder capitalism is the best alternative, or a better alternative. But if you look at Scandinavian economies, they do not go by shareholder capitalism, and instead other alternatives, and the outcomes are very positive in the sense of their real GDP is one of the best in the world, and happiness levels, you'll always hear Norway has one of the best happiness levels, etc. And if you look back to profit, it's for a better lifestyle, a better well-being, etc., etc. So essentially, yes, shareholder. Why are we choosing shareholder, or the US and the UK, etc. corporations from there? Are you choosing to go towards shareholder capitalism when these other alternatives clearly will come out with better results?
Yeah, so I would say, I'm sorry.
Let's just collect 3 questions, if that's okay, and then go for it. Go for it. Just go ahead.
Hi, thank you for the talk. I'm Tyler Smith. I'm an executive student studying behavioral science. I think just getting back to this issue around theory and the real world sitch, I think your argument hinges on both economies operating kind of perfectly and political systems operating perfectly. And we have eyes and ears, and I think we can all think back to plenty of examples of where corporations have been exploitative or extractive. So thinking about mental health and social media, opioid addiction, environment, tobacco, take your pick. There's plenty of examples out there. And I think, you both said you're interested in behavioral science. I think there's a lot of ways that people can play with heuristics and biases and fear and get people to act in ways that are not necessarily economically beneficial for them. And we also know that there's a lot of negative externalities that come from that type of behavior. And so people that are the shareholders of these organizations, they don't absorb the full costs of their behavior, nor do the companies. And I think it's a little naive to think that we would put in place regulation or create laws in that situation that would try and redistribute some of that power, because it's also quite clear that shareholders and corporations have a disproportionate influence on the political system. In the US, we buy elections. It's not perfect. So I'm just curious, it seems to me the ESG argument is a bit of a red herring. I think what we're talking about are guide rails. And when regulation does not operate or public participation is not what it should be, what are the guide rails that we should all put in place so that we don't witness the type of exploitation that we often do?
Maybe those two, yeah.
Those two? Okay. So I'll start with Scandinavia. So I would say they are capitalist. I mean, they have it. What's that?
Not fully. They're like more mixed.
I don't think so. I think, so I would describe, Sweden flirted with being socialist in the 70s. It didn't work. They left it. I would say those are capitalist economies that are more highly regulated than, say, the US, that have maybe higher taxes and a bigger safety net than the US. And if they want to have that, I think that's great. I think the best system for them, like within the framework that, within the framework that a Scandinavian government puts on its firms, that they can create value for other people by pursuing shareholder value. I think it works the same there. But I don't think there's any problem with them having more progressive policies than we do. I mean, they can just have a different preference. Policies have cost, and so yeah, I don't really have any criticism of those systems. I don't know that I think I don't know that Scandinavian firms, yes, they're trying to create profit. I don't know that they have some other type of metric that they're really using. But just in general, like governments doing different things, I think it's fine. And so here, I'm trying to think about what the question.
So the idea of using kind of things that heuristics, biases, et cetera, that will maximize profits, but actually can go against the interests of the consumers and the employees.
Like keeping my kids away from social media,
Exactly.
like stuff like that. Yeah, I think that's fair. So I would describe it like this. So I feel like, I think the straw man argument against capitalism is that it's flawed, and then people will point out the flaws. And so I think someone who's promoted in favor of capitalism or shareholder capitalism like me, my argument is not that it's perfect. Okay? So anything that humans do is flawed. So in shareholder capitalism, you have flawed firms run by flawed people, okay, regulated by a flawed government, so everything's imperfect. And so then what are the guardrails that you're talking about? The guardrails are some other people who are also flawed and don't like what's going on, want to come in and impose what they would like on this system that we have between firms and governments. So all that really does is you just introduce an additional flawed mechanism. And that flawed mechanism, largely, I would say empirically, it's just stuff that progressives want.
But what are the guardrails that might be good here?
I'm not sure. I'm not in favor of other. I'm not in favor of some third party that wasn't. So you're not elected by anyone. You're not you're not the person that put up the capital of the business. You don't get to tell the business what to do. That's how I think. I don't see why some third party should come in and say, hey, there's trillions of dollars of capital that are controlled by these businesses. I own almost none of it. But because I think I have good ideas and guardrails and I don't like the way government's being run, I'm going to come in and impose my own things on that. I don't think you should do that in your own country. I don't think you get to do it in other countries. So I think it's just taking something that's already flawed and adding another flaw to it. The difference with this other flaw is it's not disciplined by a market and it's not disciplined by elections. It's just people try to imposing their stuff on other people. I think it's a bit like tyranny. What's that?
How do we fix then the flaws that you're describing?
I don't think I don't know how to fix all the flaws. So, but again, we don't get to, so we shouldn't have a fantasy like there's a perfect way to do things. Like perfect is the enemy of good. So what I say we do is we look at all the flawed things we have, and we try to pick the best one, and then we do the best we can with it. I think that's all we get to do. And yeah, everyone's right. I mean, I think your comment too. Like, yeah, in the real world, like here's the situation, and it's kind of different. And what do we do? I still don't see. I still don't see any other type of decision rule or way of doing things that kind of gets us better than kind of where we are. And I actually think where we are is a lot better than it's been. Again, go back to 1970, when the world was half the population and 40% was in poverty. What got us out of that? It wasn't people like me up here lecturing. It was people doing business and working with each other. So I don't see why people like me should be inventing other types of policies to govern, what all those people were doing. I think we work our way out of poverty by capitalism and profits and things like that. Yeah.
We have a question here, and let's take a couple questions. This one.
Hi there. My name's Toby Baxendale. I'm an entrepreneur and professional investor. So what I just wanted to draw out, actually, is your point, Neva, is that when you see the quarterly accounting reporting issue is a real issue that does incentivize management incorrectly. Yeah. And you see this in the most terrible examples of when a set of managers will use a share buyback, for example, to reduce the number of shares to increase their earnings per share and to hit their earning per share target, and whoopie-doo, they get massive, great big bonuses. Mm-hmm. They've done it at over net asset value of what the company is worth, so therefore it's decreasing shareholder values, but giving management an instantaneous hit. So these things, people like myself always watch out for. So as you say, it's not a perfect system at all. It's a brilliant system, but it's not perfect, and there are these imperfections that come up all the time. So that's just one point I wanted to make. And the other point I wanted to make is there's a study that you might like to look up. I know Credit Suisse doesn't exist anymore, but they used to monitor publicly listed companies with high participation from the original family members, and lo and behold, they always perform better over any given time period than your equivalent PLC, publicly traded company with
the family.
The family of the ones with so like LVMH, for example, where you've still got a high participation from the original family members. They vastly outperform because they do take a multi-decade, multi-generational interest in their businesses. So and it's interesting when you look at Warren Buffett's share portfolio. For example, the ones that he's taken private are invariably businesses with high family participation in. Yeah. So it's just the incentives, and certainly what I'm always looking out for when I'm investing is in public companies that do still have high participation of original family members and long-term share incentive schemes for management rather than short-term incentive schemes. So I'm just some observations. It's not perfect, but
Yeah, I agree. Well, but to both your points, right? So what you're both talking about is, my point is, okay, the goal of the firm is to maximize shareholder value. And you're giving examples of where people focused on the short term, and that was bad for shareholder value. So, okay, so what you're saying then is that that's a bad strategy to create shareholder value. And I agree with you. But that doesn't contradict the idea that it's a good thing to maximize shareholder value. Yeah. But yeah, I agree with you. If managers are doing things that would detract from shareholder value, then that's a bad thing. And short-termism does that. I agree.
There are some systematic things that you could actually legislate out.
Yeah.
in there to make the system.
I think that'd be great. Yeah. No, I'm all for that.
Yeah, I think a lot 100%. Of the questions are how.
How.
To get to the
how to
you're seeing.
Where I take an issue with the short-term thing, and you can. I've seen this, and this came from, what's it called, the European Commission, and also from something at the World Economic Forum on how to rate firms, where people are literally saying, a firm makes a profit, you could give it back to shareholders or invest it. The shareholders don't want you to invest it. They want you to give it to them so they can have dividends or share repurchases, and that's shareholder capitalism. And my point is that's completely wrong. If those shareholders want to maximize their wealth, if you have a good investment, you should make that investment. Shareholder capitalism doesn't, it doesn't in any way say skip a good investment and return money to shareholders. So that's why that's kind of what but I agree with both of you about short-term.
So one last question here, and then.
Hi there, my name is Guy. I work in public health, so I probably am a bit more pro-regulation than many people in the room. I suppose what I found interesting about the way you constructed this talk was very much that profit is an apolitical measure, and therefore that's what makes it successful. And a lot of what you were saying was that we very much have to work within the rules and regulations, and that the rules and regulations should be set by an elected democratic body, and that's why fund managers shouldn't be the ones directing that. How does that fit with political lobbying by profit-seeking companies?
That's a good question. That's a good question. I would say sometimes it's not a bad thing. So sometimes, like let's say you want to talk about environmental regulation, and people say the oil companies shouldn't lobby. They're just trying to. Well, I would argue the oil companies probably represent a lot more people than the environmental groups do, despite what the environmental groups will tell you. The oil companies everybody's an oil customer. So now it still might be in the end you should do this regulation that the oil company doesn't want and everyone else does. But the oil company should still be talking to politicians and say, if you do this, this is what it's going to cost. This is what it'll do to us. In the end, the politicians might say, fine, that's the cost, but they still have, they still get affected by it. So I think those are hard questions. How should firms lobby? Where I'm more sensitive to it is like in healthcare. I think we're getting off topic, but I think our regulatory agencies are somewhat in healthcare captured by the pharmaceutical companies, like the approval process and things like that. And I think it's a problem. So the reason, and I think it's anti-capitalism. So here's why it's a problem. Yeah. So the reason is like, let's say you have a drug, and I don't know if I should take the drug. So capitalism works when you try to sell me something, and I can evaluate if I want it or not. But let's say I can't evaluate that. So I have a regulatory agency telling me if I should take this or not. But the company captures the regulatory agency, and they tell me to take a drug I don't need. So I would say that's bad, that's wrong, and that's not really capitalism, because now I'm not freely making a decision. So capitalism works when everybody gets to freely decide on something. If someone is given false information or something like that, then it's not working. So I'm sensitive to it. I think firms should have a voice with regulators. Regulators should know how they're impacting society. But I think regulatory capture is a problem, and I think in my country it's a real problem.
What a fantastic note to end on, that we actually need the freedom of choice and information and knowledge for consumers, for employers, and for shareholders to know what they're getting into, to make the choices that could then aggregate and create this sort of long-term shareholder value and economic growth that can create such all the great things you mentioned, David. I just want to really thank you. And I want to say to the audience, there you can feel the heat in the room on this topic. It's incredibly important that we have this dialogue and that we listen to each other from all these different perspectives. So thank you for coming with an open mind. Thank you for presenting your perspective, David. And let's keep the dialogue going.